Welcome to the world of ERP systems, where efficiency meets organization. Whether you're in manufacturing, retail, or healthcare, ERP systems are the backbone of streamlined operations. And today we're diving into a crucial component of any ERP system, the Chart of Accounts, or CoA. Stay tuned. Hello everyone. Welcome back to my channel. I'm Manta, and with over 20 years of consulting experience across various industries and geographies in the ERP space, I'm here to guide you through the fundamentals of ERP systems. Today we're diving into the Chart of Accounts, or CoA, often referred to as the backbone of any ERP system. But why is it called the backbone? And why is it so crucial when implementing an ERP system? Let's break it down. First things first, what exactly is a Chart of Accounts? Simply put, a CoA is an organized list of all the financial accounts in a company's general ledger. It's a framework that categorizes all your company's financial transactions. First, let's define what a chart of accounts is. Think of it as a structured tree with branches representing all the financial accounts in an organization. It includes assets, liabilities, equity, revenues, and expenses. This structure helps in categorizing financial transactions, making it easier to track and report financial data. Also think of it as a library catalog for your finances. Each segment in the CoA is assigned a unique code, making it easy to locate and reference transactions. Now, why do we call CoA the backbone of any ERP system? Here are three key reasons. First, it provides a standardized structure for financial reporting. This consistency is essential for accurate financial analysis and decision-making. Second, it ensures data integrity and control. With a well-structured CoA, you minimize errors and discrepancies in your financial data. Third, it supports seamless integration with other modules in the ERP system, such as purchasing, sales, and inventory. This integration is what allows for real-time data flow and comprehensive business insights. Setting up your CoA is one of the first steps when implementing an ERP system. Here are some best practices to keep in mind. Understand your business needs. Tailor your CoA to reflect your specific business processes and reporting requirements. Keep it simple and scalable. Avoid overly complex structures. Ensure it's easy to expand as your business grows. Ensure consistency. Use consistent naming conventions and account numbering to maintain clarity and uniformity. So why is the CoA so important during ERP implementation? Imagine building a house. The CoA is like the foundation. A well-structured CoA ensures data accuracy, efficient financial reporting, and compliance with accounting standards. It also facilitates better decision-making by providing a clear financial picture. Designing an effective CoA is crucial. It should be detailed enough to capture necessary information, but not overly complex. Here are some tips. Start with the basics. Identify major account categories. Hierarchical structure. Organize accounts in a hierarchical manner. Consistency. Maintain consistency in account numbering. Flexibility. Ensure it can adapt to future changes and growth. The CoA is often called the backbone of ERP for a reason. It integrates with various modules like finance, HR, and supply chain. A robust CoA supports seamless data flow across these modules, ensuring that everyone in the organization works with the same financial information. Let's look at some real-world examples. In a retail business, a well-structured CoA helps in tracking sales, managing inventory costs, and monitoring expenses. In manufacturing, it aids in cost accounting and production efficiency. Best practices include regular reviews and updates to the CoA to reflect any organizational changes. The attached sample coding for the account type asset in a chart of accounts, CoA, provides a structured hierarchy of asset accounts categorized into non-current and current assets. Here's a detailed description of each element. Number. This column lists the unique numerical codes assigned to each account. These numbers help in identifying and classifying different types of assets. Description. This column provides a detailed description of each account type within the asset category. Roll-up. This column indicates the level of hierarchy for each account, which helps in the roll-up of financial statements. Levels, L0, L1, L2, signify different layers of detail. L0, top level, for example, assets. L1, subcategory, for example, non-current assets, current assets. L2. Specific accounts within each subcategory. Asset coding structure. 1. Assets, L0. Assets. This is the top-level account encompassing all asset accounts. 2. Non-current assets, L1. Non-current assets. This category includes assets that are not expected to be converted into cash within a year. Intangible assets, net, L2. Assets without physical substance, like patents or trademarks. Property, plant and equipment, net, L2. Tangible fixed assets used in operations. Investments, L2. Long-term investments in other companies. Deferred tax assets, L2. Taxes paid in advance or overpaid, which can be used to reduce future tax liabilities. Related party notes receivable, L2. Receivables from related parties. Derivative instruments, L2. Financial securities whose value is dependent on underlying assets. Retirement benefit asset, L2. Company contributions to employee retirement plans that exceed the expected obligation. Trade receivables and other non-current assets, L2. Receivables and other assets that will be collected or used beyond 1 year. Total non-current assets, sum of all non-current assets. 3. Current assets, L1. Current assets. This category includes assets expected to be converted into cash within a year. Trade receivables and other current assets, L2. Amounts due from customers for goods or services delivered. Derivative instruments, L2. Short-term financial instruments. Inventory, L2. Goods available for sale or raw materials used to produce goods. Related party receivables, L2. Short-term receivables from related parties. Cash and cash equivalents, L2. Cash on hand and other assets that are readily convertible to cash. Total current assets, sum of all current assets. Total assets, sum of all non-current and current assets. The attached sample coding for the account type liability in a chart of accounts, CoA, outlines a structured hierarchy of liability accounts, categorized into non-current and current liabilities. Here's a detailed description of each element. L0, top level, for example, liabilities and owner's equity. L1, subcategory, for example, non-current liabilities, current liabilities. L2, specific accounts within each subcategory. 20 series liabilities and owner's equity. This is the top-level account encompassing all liability and equity accounts. Non-current liabilities, L1. 21 series non-current liabilities. This category includes liabilities that are not expected to be settled within a year. Current liabilities, L1. 22 series current liabilities. This category includes liabilities expected to be settled within a year. And lastly, total current liabilities, sum of all current liabilities. Total liabilities, sum of all non-current and current liabilities. The attached sample coding for the account type owner's equity and capital in a chart of accounts, CoA, outlines a structured hierarchy for equity accounts. Here is a detailed description of each element. L0, top level, for example, owner's equity. L1, subcategory, for example, additional paid-in capital, accumulated profit. L2, specific accounts within each subcategory. Owner's equity, L0, 30 series owner's equity. This is the top-level account encompassing all owner's equity accounts. 2. Additional paid-in capital, APIC, L1, 31 series additional paid-in capital, APIC. This category includes the capital that shareholders have invested in the company above the nominal value of the shares. 3. Accumulated profit, loss, L1, 32 series accumulated profit, loss. This account tracks the cumulative net earnings or losses that have been retained in the company rather than distributed as dividends. 4. Accumulated other comprehensive income, loss, L2, 321 series accumulated other comprehensive income, loss. This account includes items of income and expense that are not recognized in the profit and loss account but are instead recognized directly in equity. This can include unrealized gains and losses on certain types of investments. And lastly, total owner's equity, sum of all equity accounts. Total owner's equity and liabilities, sum of total owner's equity and total liabilities. This chart of accounts sample provides a clear and detailed structure for categorizing liabilities. It includes hierarchical levels to organize liabilities into non-current and current categories, further broken down into specific account types. This structure is crucial for accurate financial reporting and analysis in an ERP system, ensuring all liability-related transactions are properly recorded and tracked. To wrap up, the chart of accounts is an essential component of any ERP system. It lays the foundation for accurate financial data, integrates various business processes, and supports strategic decision-making. Designing an effective CoA is a critical step in ensuring the success of your ERP implementation. If you found this video helpful, give it a thumbs up and don't forget to subscribe for more insights into ERP systems. Have any questions or want to share your experiences? Drop a comment below. I'd love to hear from you. Thanks for watching and see you in the next video. Until then, happy ERPing.